Gold hit a record high in 2023. Can it be sustained? Will it move to a new high this year? Today, at the Commodity Exchange podcast, we are joined by Philip Newman, Managing Director and Founder at Metals Focus, an independent precious metals consultancy, and Philip will help us explore these questions and much more. Welcome to the Commodity Exchange, a podcast where we bring to you insights from the world of commodities. Whether you're an investor or just want to learn more about the topic, this is the podcast for you. Before I begin, we do need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and Metals Focus and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. And now, with the compliance wording out the way, welcome, Philip. Thank you so much for joining us today on our podcast.
Well, thanks, Nitesh. Pleasure to be here again.
Welcome. You're welcome. And before we begin, why don't you tell us a little bit about Metals Focus for the benefits of our viewers unfamiliar with your firm?
Absolutely. So, as you mentioned, I'm one of the founders of the company. There are three of us that own Metals Focus. We're now in our 11th year, and Metals Focus focuses exclusively on precious metals research and consultancy. We don't trade the market, so we, have, I think, a truly sort of independent view of how the markets are progressing. We've got a team of about 30 spreads across 8 markets, and what we really focus on as a research house is getting out there, speaking to companies across the supply chain. I mean, bear in mind, most companies are privately owned, and so really what we're trying to do is uncover information which is not in the public domain. And that helps us to put together our historical and forecast supply demand data sets.
Wow, that's amazing. And we'd love to tap into your insights today. So, as I mentioned in the introduction, gold hit a record high, but it hit record highs in yen terms in March of last year and kept going higher. It hit record highs in euro and rupee terms in March as well, but they contracted in those currencies. But pretty much in every major currency, they hit all-time highs in December 2023, including the US dollar. So tell us what happened. What was so unusual about December 2023 that drove gold prices to these new highs?
Sure. I think really there are quite a few factors. I guess the first thing we've got to understand, of course, that December can see quite thin trading conditions, and so any move to the upside or downside can be exacerbated. So I think that's the first thing to put some of those moves into context. But then when we look at what was going on, of course, there was a lot to unpack in the market at that time. Of course, that was only really a couple of months, after 7th of October, when hostilities started between Hamas and Israel, and so we saw the market really moving higher, gold really catching that safe haven bid much more really than any other precious metal. And then against the backdrop of that, because investors or the markets were concerned, what would that mean for the Middle East, for oil prices, for the global economy? Investors started to think then that the Fed would adopt a much more dovish stance than at that time the Fed was talking about, especially early December. And so again, that really encouraged investors to go to the long side, driving prices higher. That, of course, culminated when we think again in December, mid-December, with the FOMC meeting, when the Fed actually did come out and say that they would start to, their target, sort of the N24 target for rates was, somewhat lower than they've been talking about even at their previous meeting. And again, that really, I think, to help to galvanize the markets, encouraging those long side bets, pushing prices up, as you just said.
Wow. And as you alluded to, October was an important time because, that's when geopolitical issues really flared up.
Mm.
But, in early October, gold had fallen to 1818 and then zoomed all the way to, above 2000 by the end of the month. Can you give us a little bit more context about what was happening at that point in time?
Sure. Well, I think you can, one of the key dynamics that has been playing out, over the past couple of years, and especially in the context of, institutional investors, is how, their expectations of how the Fed was going to behave, varied or approximated what the Fed was saying. And I think what we saw for much of last year is that the Fed's mantra was, I think, very consistent, talking about rates remaining higher for longer. But to be blunt, I think the market simply didn't believe this, especially early part of the year, the first 6, 7 months. There was a very large gap. In other words, the markets thought that the Fed would again adopt a much more dovish stance than the Fed actually was saying. But what we saw, which I think was really quite interesting, in the run up to early October, we saw those two positions, that gap between those two positions really narrowing quite significantly. And in that sense, that encouraged investors to unwind some of those long-sided bets to become a little more bearish in their view. And that saw gold come under pressure and silver, of course, as well. Um, and of course, that's what we talked about in terms of those very early October pressure on prices. And of course, that all changed on the 7th of October.
Wow. Um, and you allude to those geopolitical issues in October, um, but even today, geopolitics is a big part of the conversation that at least I'm having with a lot of investors today. Especially with um, the conflict in the Middle East really spreading into the Red Sea with Houthi rebels attacking ships.
Mm.
Um, what do you think about that source of gold price pressure? Is it a sustainable source of gold price pressure, or is it one of these things that tends to move away relatively quickly?
Well, that's a very good point. I mean, I think when you when an event suddenly happens, you can get a sort of a knee-jerk reaction in the markets, sending prices spiking higher. But quite often, what we've seen over the past 10, 20 years is that that's difficult to sustain. I think what we're seeing in the Middle East with the contagion gradually spreading. You mentioned the attacks in the Red Sea. We add to that, of course, Iran, firing missiles into Iraq, into Pakistan. Pakistan then, of course, reciprocating as well. Um, you know, where does that end? No one absolutely knows. But I think from our point of view, that will, for this year or for much of this year, continue to provide some safe haven bid. And that's certainly our thinking in terms of, again, where we see prices heading. I think it's very difficult when you're thinking about, what is your base case forecast for the gold price to say, well, will we see this escalate dramatically? Well, of course, we all hope not. But I think for a base case, that's I think difficult to really include. But at the same time, do we think this is going to end soon? Of course not. So I think that will certainly, at the very least, provide some downside support in the marketplace for gold.
Wow. And so you said the December rally was largely driven by rate cut expectations. But was it premature? And what is your working assumption on rates for this year?
Sure. I think it was premature to some extent. I think we've certainly seen some of that exuberance. And again, going back to my earlier point, that the fact that you had some thin trading conditions and you would normally get in December, I think exacerbated that move that we saw as well. Um, yes, I mean the markets again. We've seen gold coming off to some extent, so we are starting to see, or we've seen over the past week or so, some of that exuberance ease off, if I can say that. In terms of where the first rate cut will come. And our view is that it will be, around the turn of the first half, so maybe late Q2, early Q3. Um, and to be honest, we see no reason to deviate or to take a different view from what the Fed is saying in terms of where it sees rates finishing this year. So we think there'll be around I would suggest three rate cuts in 24, perhaps accelerating next year. But I think that three cuts is probably maybe still again a little less than the market is currently expecting. So yes. Can I ask, in terms of WisdomTree, what would you say your house view is in terms of rate cuts for this year?
Yeah, it's a tricky one. Just given that what the Fed is telegraphing doesn't necessarily accord as strongly with the data that we're seeing. So we think that that inflation in the U.S. is falling fairly quickly,
Mm,
and that does afford the Fed an opportunity to cut relatively early. Although knowing its dual mandate is also focused on the labor market,
mm,
where unemployment rates haven't risen that much, but that also may be associated with a falling participation rate. So, we're thinking around a May cut would be, or May or June cut would be the first to be delivered, potentially close to 100 basis points of cuts during the course of this year. But once again, we're operating a little bit more in the blind compared to most rate cycles because the central bank isn't offering that same degree of forward guidance that we've seen in past cycles. So that does
mm.
make things a little bit more trickier. But just where the market is placed, just to give our audience some context, the market's pricing in an 80% chance of a cut in May, first cut in May, and the probability of a March cut has fallen down to about 50% right now. And even just a few weeks ago, that was almost fully priced in,
Mm.
for a March cut. So the market is also shifting its rate expectations further down the line for 2024.
Yes, and if I could just add to that, what's really interesting is that even though, as you said, that the from a March cut being fully priced in now to 50%, and maybe that will continue to ease off that probability, I think it's really fascinating that with that downward pressure, gold is still, above $2,000. And I think, it goes perhaps to some extent in terms of the safe haven bid that's there. Um, and I think, I think investors just don't want to bet against the market. And I think that can become, I think, partly self-fulfilling as well.
Yeah, I think that's absolutely a great observation. It's clear that I think for the market, it's not a matter of if they will cut rates, but it's more when. So that's
Mhm.
so that I guess takes a little bit of pressure off gold prices. But at the same time, one thing that I've observed is the gold price has done relatively well under the pressure of rising bond yields for a lot of 2023, and a strengthening dollar in 2023. So that that there seems to be a bit more of a gap between gold, bonds, and dollar than we've seen before, and that's possibly accounted for by that safe haven aspect in gold. So if we look back to 2022, central banks bought gold at record levels. And that's a very high benchmark to beat. Um, So, what are the chances that we came even close in 2023? I know 2023 is in the rearview mirror now, but the data gathering still continues, right? So, what can you tell us about your intelligence there?
Sure. I mean, if I'm honest, as we, finished 22, with the record high you just mentioned, we certainly thought that central bank gold demand would remain strong last year in 2023, but even then, we were still really surprised by how strong it did remain. There's no doubt about it. Um, so, and what's really fascinating is that, the net figures were exceptionally strong. And that even takes into account that I think it's over the first 4 or 5 months of last year, you had almost as much central bank selling as you had in all of 2022. So even allowing for that, you still had a really strong central bank market on the demand side on a net basis of the market. So it was really, really quite fascinating. And again, we've spoken about the safe haven bid and other factors. I think it's really important that you've mentioned the central bank market because that, I think, in terms of the price support that has often provided, exceptionally important, and especially in late 22. I think it was around the third quarter when you had a lot of investor liquidations. Investors were getting quite bearish, and really the timing, of the central bank demand to come in and provide some price support was really, I think, really quite valuable for the market. And I think that has been there for a lot of last year as well, to be honest with you.
Brilliant. And so, which central banks were buying the most in 2023? And I don't know if that gives us any glimpse into what they could be doing in 2024.
Sure. I mean, I guess three stand out. I mean, China, I think, announced purchases of over 200 tons. Turkey was really fascinating. Moved from the demand to the supply, back to the demand last year. So I think overall, I think it was pretty flat, but it was really quite interesting. It sold about, I think, 130 tons in the second quarter last year, and they moved onto the demand side for the second half, buying about 100 tons. But those circumstances, were very unique to Turkey. In the run up to their national elections, I think it was in May were their elections, but over the summer, the government was really worried about the current account deficits and what that would mean for the Turkish lira. Turkey is an important gold market globally. Yes, it's a producer, but overall, by and large, it relies on imports. And so, what do? Well, you ban imports to take some of that pressure off the currency. But Turkey doesn't stop being an important market for gold, either for the local market. It's one of the top exporters of jewelry as well. So, the country needs gold. So what happened was the central bank started to release gold. I think it's about a ton and a half a day, just trying to take some of that pressure off of the market, bring down some of those premiums. But then after the elections, that there was no need. The import regulations were relaxed to some extent. And then we saw the central bank of Turkey move back onto the demand side. But just if I could just briefly touch on that, what's been really interesting is that last month the government put back not the same regulations, but they tightened up the import picture because I think it's May this year you've got some local elections, and so again gold is playing that, I guess, that political dimension, if you will. We haven't seen, to the best of my knowledge, we haven't seen the central bank move back onto the supply side yet, but we'll see because you've seen local premiums really go through the roof in Turkey over the past few weeks. We're fortunate as a company. We have a colleague based in Istanbul, so he's keeping an eye on that. So that's a slight segue away from your question. Sorry, Nitesh, but I thought that was really quite fascinating. The other one I think was Poland. I think they bought, I think it was around 100 tons last year. But to your question about what can we learn from last year for this year, um, I think it's just really interesting that it's just the range of countries that are active in the market buying gold. It is quite a broad church that we've seen over the past couple of years. Um, and I think that's part of, that broader, if you take a very, very big step back, we've seen this, I guess, this gentle trend, if I can use that word, of this sort of de-dollarization in the marketplace. So gold isn't the only beneficiary of that by any stretch, but gold certainly has benefited. And then when we think after Russia's invasion of Ukraine and how that sort of the weaponization of the dollar, for want of a better phrase, I think that has acted as a bit of a catalyst as well, encouraging some countries to increase their holdings of gold. And so for this year, are we going to see at the same pace as the past 2 years? I think that'd be surprising. Will it still be pretty aggressive? In our humble view, yes, we think so. So that again, should provide some price support. Of course, with the prices, behaving as they are, I imagine that the banks would, try to manage when they are buying gold. But I think equally, what would be really interesting, will they will their price expectations adjust upwards to these levels, and therefore, whereas perhaps last year gold at 2000, they may have eased back in terms of their activity. Maybe for this year that could be an entry point, and that's just speculation on my point, on my part, nothing more. But I think that is certainly something that we have to keep an eye on. But I think overall, as I said, they will remain in our view, a very important part of the market on the demand side.
Wow. Thanks so much for sharing those insights, and especially on Turkey. Having a person on the ground obviously must help you with the intelligence there. I, for one, just assumed that the events of last year were fairly unique for Turkey, and it will be rebuilding its stock during the course of this year. But if you're saying there's more of the same coming this year with elections, then that's definitely a risk factor to look out for. Um, why don't we switch a little bit to the retail market?
Mm,
What are the notable trends there? And just for context there, I myself work a little more on the institutional market, so I get to see the retail a little bit less. So it'd be really interesting to hear what your observations are there.
sure. Well, if we think of some of the Western markets, the likes of, and if we start in Europe, the likes of Germany, which is the big heavyweight in the room when it comes to, say, retail investment of, say, gold and silver, that has been struggling for quite some time. It was going gangbusters during COVID, all the way through to 2022. It started to back off a bit towards the end of the year, but to be blunt, it then sort of fell off a cliff in early 2023. One of the events we like to attend is the Berlin World Money Fair. They hold it in late Jan. In fact, we're there next week, and that attracts basically most mints from around the world, and that in turn sort of brings in the supply chain, so the dealers and the refiners. So it's a great place in a few days to really catch the pulse of the market. And dealers come from all around the world, from the US, Australia, New Zealand, etc. So it's a great location. And what we found when we were in Berlin last year has really carried on for much of the year, I think into early 24 as well. So, with, you mentioned earlier the strength of the euro price that encouraged profit taking. Something that happens in Germany is that they only tend to adjust their energy prices once a year. So the end of 22, as a consumer, you get a bit of a shock. That encouraged some liquidations as well. You have the interest rates becoming positive for the first time in quite some time. So banks are now going out aggressively marketing, trying to attract funds. You have that as a competition for gold. So gold and silver have really struggled. Silver had the added issue of they changed the sales tax at the end of 2022, which probably is worth a whole new podcast just to go through that, I'd imagine. But so you had a lot of headwinds that the market has had to face it in Germany. And as I said, to the best of our knowledge, it hasn't changed a great deal. And as I said, we'll get a flavour when we're there late next week. When it comes to the US, more mixed. You've seen, I think, an upturn in secondary activity, so investors liquidating because where prices have been. Um, and so, but a lot of that in dealers have been able to turn around and sell. So although sometimes it's depressed the net figures, on a gross basis, the buy sell has still been pretty interesting. And again, we'll get an idea when we're in Berlin how things are. January is always interesting because you've got the release of newly dated bullion coins by all the key mints. That gives you, added impetus. And so that can make it a bit difficult to really figure out what's really going on. But again, when we're in Berlin, we get an idea of where the orders are, and the mints and the dealers will get a sense of where their February and March orders are, etc. So, but I think it's been a bit challenging. But we've got to bear in mind that as I said, Europe all the way through to 22. You can always argue that I mean, in 3 years the market was probably buying the equivalent of say 4 or 5, or say at least 4, maybe 5 years worth of products. So one's got to take that into account. Is there the appetite to keep adding to those holdings as well? So that's something just to add a bit of context in terms of some of the subduedness that we are seeing um, at the moment. I mean, can I ask you, Nitesh? I mean, so that's where retail investors are, responding to, I guess, some of those issues like cost of living crisis and so on. I guess for institutional investors, it's not quite the same drivers. I mean, what are you hearing from those you're speaking to?
Yeah, that's a great question, and I think we do see quite different behavior from retail and institutional investors. Why you say the demand from certain corners of retail was somewhat muted in 2023. From the institutional side, I think it was even worse in terms of there's even less engagement with the gold market in 2023. Partly because gold is seen as a defensive asset. And there was another defensive asset last year that became very cheap, and that was bonds.
Mm,
So when you saw bonds, whether we think talking about US 10 years or um, even many of the that similar maturity bonds in across Europe, they'd hit uh, levels in terms of prices that were so low that put their yields back to that sort of 5% region. And therefore, lots of investors were out there bargain hunting for those bonds, and they were, funding it with part of their gold, or they're replacing their gold with bonds to provide that defensive play in their portfolio. So for much of 2023, if you look at the exchange traded product space, we saw outflows from gold. Obviously, as bond prices rise, as in bond prices fall once again, we expect a turnaround in that during 2024.
mm,
So there should be that little switchover point. But once again, um, if investors are looking for inflation hedges and they look back to 2022 and 2021 when inflation was extremely high, it seemed like a broad commodity allocation was the best hedge against that inflation that we saw during those periods of time. And so, once again, gold may have been somewhat in the shadow because there were other asset classes that were, shining a little bit brighter at that point.
sure. I mean, just coming back to the US specifically, I guess I've been surprised that from a retail investor, we don't hear much about the US election. Is that the same in the institutional space, would you say?
I think increasingly the election will become a topic, and while it's still early days in 2024, I think as the election campaign heats up, that will become a lot uh, larger part of the conversation.
Mm,
And if we cast our minds back to the 2016 presidential election that came with some with some shocks. um, Gold prices did what nobody was expecting. As soon as you had, the candidate that wasn't the lead in the polls become the president, gold prices actually fell.
mm,
So it was somewhat counterintuitive. Gold is often seen as a hedge against shock events.
mm.
Yet its price fell, and that may just be this sort of interaction between the institutional and the retail markets, because very often the retail markets they tend to be a little bit more driven by the sort of the conservative uh, end of the political spectrum, and having a Republican candidate that would possibly deliver some of the things that they want to see in terms of economic policy, come as the lead, and become the president, actually fell in their favor, and they looked less towards gold as that economic hedging instrument. And maybe that's what happened in 2016. So it'll be interesting to see what happens this year, because that same presidential candidate is looking like the lead from the Republican corner, and and is looking from polls, does look like could be a quite favorable candidate to become a president once again. So we'll see whether 2024 looks similar to 2016.
Sure. And I mean, I think there are echoes for US retail investors as well, because again, when they think about having a Democrat in the White House, what that means for spending policies and then for inflation, that would encourage them to buy gold. So having a Republican in tends to, again, they think that results in better economic management, and therefore there's less recourse to hold, precious metals. So we will see how that plays out. Whether that means actually outright liquidations, I think is a different one to call. But it could see physical demand and ease off towards the back end of this year and into 25.
Absolutely. I was wondering if we could turn our conversation to silver a little bit. So silver has lagged gold for some time. Um, the gold to silver ratio is hovering around that sort of 88 level,
Hmm.
which is about a standard deviation above its 10-year average. Um, do you think that it could get back to that sort of 80ish level? So back to around its average?
I think, in short, yes, but I think it will take quite some time for that to happen. I don't see that, I think, happening this year. And you mentioned where the ratio is now. I mean, it's only I think a few days ago, it was, I think, about 92 and change or thereabouts. Um, and I think, investors would look at that, and I think they'll be disappointed by that. That, we've spoken a lot, in this podcast about the safe haven bid that gold has benefited from. And I think, not much of that seems to have come silver's way. Um, and I think it can potentially become a bit of a vicious circle. Normally, when gold's doing well, silver performs to the upside, and we certainly haven't seen that. And I think, investors looking at that scenario could, again, focus some of their firepower on gold rather than silver, helping it to underperform. I think it's struggling a little bit as well because, as you know, it can behave as an industrial metal sometimes. And with the challenges in China, with the property market and so on, I think that has weighed on silver to some extent. So, and this is happening against the backdrop of what is, of, a market in a pretty chunky, physical deficit. And I think, again, investors look at that and they do, so I think, scratch their heads when, Metals Focus and others come out and talk about a deficit. And well, how can that be when silver is, with the ratio in the high 80s? And we think it will take, again, some time for that to play out. Again, taking a crystal ball view for a few years out, we think the deficit will carry on, and ultimately that will help, silver to outperform to some extent, bringing that ratio somewhat lower.
Wow. And so, um, your forecasts that point to that deficit.
Mm.
What really driven that deficit in 2023?
Sure. Well, if we just take a step back and you look, you take the 2010 to I think 2021 period, the silver was really moving in a relatively narrow surplus or deficit. I think it was only in 22 when things really kicked off. We saw a marked rise in demand, and that has continued to rise to varying degrees. But what we've seen in the upside in supply is simply hasn't kept pace. Um, and so I think that's fundamentally what you're seeing in the marketplace. And we can point to, in I think it was 22, where we saw really India go to the races in terms of its jewelry and silverware, but that backed off really quite aggressively last year. But even so, we still saw, a pretty tasty deficit in 2023 as well. And so I think one of the key things is on the industrial side, and is that step change up in industrial silver offtake, which I think is underpinning much of that. And that's not going anywhere. We're seeing industrial demand, hit a new high in 23. Is that about to change? We don't think so. And so I think ultimately that's what's driving that and, contributing to that shortfall that we're seeing in the marketplace. And again, as we crystal ball gaze out a few years, it's hard to see that changing anytime soon, if you're honest with you, Nitesh.
Wow. And on the industrial side, I think a large part of that came from the rising demand from photovoltaics, right?
Mm, yes.
Do you see that continuing, or is that renewables focus losing momentum or gaining momentum? What can you tell us about that?
Sure. Well, it has been, one of the success stories in the silver market. Last year, and we're still finalizing our figures, if I'm honest with you, but you've got probably somewhere in the region of 180 million ounces of silver going into the photovoltaic market, into PV. That's about, I think, 27, 28% of global industrial demand. 10 years ago, PV accounted for 10% of industrial offtake. So it's really done incredibly well. Um, One of the reasons why last year was so strong was, well, I guess there were a couple of reasons. I mean, China was number one. It accounted, I think, for about a half of global installations. I mean, we know that China dominates in terms of, the powder, the paste, the panel manufacturing, but in terms of actual installs, it just went gangbusters. There was a commitment, I think it was late 22 or early 23 by the Chinese government towards green technologies. And then, the local authorities or the local provinces really started to aggressively install. And although they had guidance for targets they should hit, in the second half of the year, they just went through those targets and, exceeded what they should have done. And that was really fascinating because it meant that, a lot of the photovoltaic forecasters, in terms of where they thought 23 would end up, had to keep revising their figures up as we went through last year. But the other thing which was really fascinating is that the number of countries that install at least 1 gigawatt of PV capacity has really gone up quite sharply. Um, and so even though China dominates, you've still got an increasing number of countries that are installing PV. And even though I think there's concerns, or I have a concern for, can China maintain the same pace this year? The fact is, you're getting again ever more countries, joining that party, and I think that's been, really quite interesting, quite fascinating for the PV industry.
Wow, that's some amazing insights. Thank you so much, Philip, for sharing your valuable time with us. Um, Please do let our audience know how they can read more of your material and follow you.
Sure. Well, if they go to metalsfocus.com, they'll find details of some of our products. A lot of what I've been saying today, is taken from our 5-year silver and our 5-year gold, and some of our short-dated reports. So yeah, go to Metals Focus or reach out to me directly. We're very happy to chat.
Great. Well, thanks everyone for tuning in. We hope you've enjoyed today's episode of the Commodity Exchange. If you want to hear more about us from WisdomTree, please do subscribe on whichever platform you're using. You can follow me on X, formerly Twitter, with the handle at Nitesh Shah WT. And if you want to learn more about commodities, visit WisdomTree's website, where we give a range of research materials and insights. Until next time, thank you.